morning and happy Cinco de Mayo. I'm working more today on my stock market project. If you're interested in any of this stuff, I'm basically trying to automate something to make money consistently in the market using Python. So if you're interested in that, programming, Python, AI coding, any sort of markets, follow along because I work on this every day. So, yeah, subscribe and of course like the stream. So let me go over really quick the goals for this project. Then I'll go over what where I'm at, what's happened recently, and what I'm going to be working on today. So my first goal is beat the S&P 500 by a significant margin while staying market neutral. So what's this mean? The S&P goes up on average 6% per year. I want to do significantly better than that and go up on average 3 to 4 times the S&P, so 18 to 24% per year. Now the second goal is to stay market neutral. If there's a recession like in 2022, 2008, something like the COVID crash, I want to be immune to this. I want, regardless of if the market as a whole is going up or down, I want to be able to turn a consistent profit. So stay market neutral and return 18 to 24% per year. Then I'm beating the S&P by a significant margin. So I'm writing all of this code in Python. So I have a secondary goal for the project, which is generalizing it into something that anyone can use to make any sort of model for themselves. So I've been plugging away at that. I'm updating the GitHub consistently. So if you're interested in that, go to the GitHub link in the description, download the repository, fork the repository. You can do everything I'm doing to define a stock universe and create a model and create a portfolio strategy in about 100 lines of code. So this is the outline of what I'm doing here at the bottom. I have data going back to 2011 that consists of everything that's been listed in the stock market during that time. Now, you don't want to use everything for a few reasons. So first of all, stocks like Apple and Tesla are going to have different price movements from ETFs. So there's different types of assets that move differently. So you need to kind of unify to one type of asset or a family of assets that you can kind of train the same thing on. So that's the first thing. That's for the stock universe. You also want to have high volume stocks. You don't want to have anything that has low volume. One, it has a low bid-ask spread. There's going to be more slippage in the price. And two, you won't be able to scale it up. So the ultimate goal with these always is scaling it up, hyper-scaling it, and getting a lot of money to invest in the model. So if you want to do that, you need high volume stocks. So I've defined a universe that seems to be working pretty well. Once it's defined, I'm creating a returns model. This is predicting something like returns for the stock, returns relative to the market, relative to sector, probability of a positive return, something like that. I've found the best success so far in predicting the Sharpe ratio relative to the market. And so now that I have a good returns model, I'm working on the portfolio level phase of this, and I'm kind of tweaking them inversely. So I got a good returns model, then I worked on a portfolio model, couldn't find something good, tweaked the returns model a bit, tweaked the portfolio model. So I'm kind of going through that process iteratively. So why do I think I have a good model? Let me show the model I arrived at about a month ago that I think is good. So the first reason I think it's good is if we look at these metrics in the red box here. So the top metric is information coefficient. That's telling me about the predictive power of the model. My goal is 0.01 to 0.02 because the stock market has a notoriously low signal to noise ratio. I'm getting a value of 0.04, so quite a bit larger. Um, the next four metrics: information coefficient, standard deviation, information coefficient to information ratio, and the T statistic. These are telling me about the stability of the model. So you kind of want to balance those two things. You want something that has a lot of predictive power, but you also want something that's stable. So it's well above for the predictive power metric. For the information coefficient standard deviation, my goal is 3 to 13 times the information coefficient, which is documented from successful strategies in the past. Um, this is about 3 times, you can see. Uh, the daily information coefficient to information ratio should be 0.03. So here you see 0.3. It's larger by an order of magnitude. And on an annual basis, my goal is 0.3. I'm getting 2.3. So again, larger by about an order of magnitude. My T statistic goal is 1.98. This is about 2 times that. So on all of these metrics, it looks really good, both on performance and stability. Um, Now we have this decile analysis. So the ideal decile analysis, the bottom decile is the worst performing, top decile is the highest performing, and it should be monotonically increasing in between, which means each decile is higher than the previous decile. And that's exactly what we see here. This looks like a perfect decile analysis. So not only are the metrics good, the decile analysis is really good. Now this is for a single model that's tested from mid 23 through the beginning of 26. So I also tried a walk forward analysis where I trained a new model each year from 2016 through 2025. And you see that the information coefficient never drops below my goal, and the information coefficient to information ratio never drops below the goal either. So for all of these reasons, this model looks really good. I went through and tried implementing a portfolio strategy on it, and I found something kind of interesting, kind of problematic. So the main thing that I found here is on the single model that was tested from 23 to mid 23 to the beginning of 26, it was really easy to get a portfolio strategy that worked. So almost anything I tried gave me good results on the portfolio strategy. You see the Sharpe ratio almost never drops below 0. So really easy to get a good model. When I implemented the same strategy from 2016 through 2026 on the walk forward results, it was a different story. It does well on this later region, but it basically failed from 2016 through the end of 2021. It became increasingly negative. So although this does really well since 2023, this is a big problem here. It's not, I'm not very confident in this strategy. If I had started in 2016, I would have been underwater for almost 6 years while I waited for it to go positive. And so that's not something you could really do in real life. So why is this? The first reason it could be is this dispersion plot. You see the dispersion in the market increase significantly after COVID. And the reason for this is really the rate of new stocks being listed went way up, and the amount of retail traders increased. So there were way more people participating in the market with free money from printed stimulus checks. So the problem I'm having here is if it does well at later times, it does poorly at early times. So then I tried optimizing it and saying, okay, well, what if I optimize to the early times? And let me find that result. Oh, here it is. So this is optimized from the beginning of 2016 through mid 2018. You see it does well on that region, and then afterwards it does very poorly. So if I do well at later times, I do poorly on early times. If I do well on early times, I do poorly on later times. So I'm not able to really get a good portfolio strategy with this. So I looked at the model itself, and I found a couple things. The main thing I found is that on early years especially, it's not always perfectly monotonic, and the spread is changing significantly from year to year. So I tried a better model. So the next thing I tried was this model, which is I dropped out all features that had a coefficient of variation above 1 or a mean importance below 0.05. Um, and not only do the decile charts look better, the performance is actually better. So now instead of having early versus late time it performs well on, it's really doing well the whole time, but it suffers during the COVID crash. So um, I looked through at the number of validation years to use. I found that using more validation years is better. And then I created this new model. So at the top is the same model as the original model, but I added in some new features which are sector neutral. So I added in mean reversion and volatility features, neutralized to the sector, while leaving in the ones that have been already neutralized to the market. And in this top model, I actually did better than the previous model. Then I tried the same thing, just keeping the most important features, and it actually performed worse. So I'm going ahead with this top model, model 25 here. Um, and so yesterday I was varying around things to see. Uh, Basically, the workhorse here is the volatility constraint. So this is no drawdown threshold. Uh, there's no other scaling parameters. It's just scaling on volatility. So I went through and said, okay, with this volatility scaling, if I implement information coefficient scaling, can I get better results? And some of these look really good, basically good enough to implement. Like here, you see basically steady upward trend. It crashed during COVID, but then it recovered very quickly. The worst drawdown here, just over 20%. Drawdown duration under a year, and that was COVID. That was kind of exceptional. So this looks really good. It looks like I'm headed on the right track. But here, yeah, I wasn't able to notice any trends by varying the information coefficient parameter. So then I was looking at, does increasing the number of trials improve performance? It seems like it does, but I did 500 trials and that didn't improve performance. So this is if I train only on 2016 and then test it afterwards. And this actually looks really good too. It found a really good strategy. There is this really bad crash in 2024, but other than that, this looks really good. So now I just did this one, so I'm going to try this. So if I train 16 to 19 with 200 trials, here are the parameters I get. Maybe I should let it hold fewer positions. Okay, so let's set these parameters now. So end positions. To scaled HRP. Okay, 5 longs, 5 shorts. Rebalance days 2, holding period 5. HRP look back 90. Buffer multiplier 2.5. Smooth predictions false. Sizing method beta neutral. Target volatility 0.1. 60-day look back. I might have already set this. Max volatility leverage 1.5. Drawdown warning threshold minus 0.25. Yeah, I think I already have this in. Drawdown penalty 0.25. Drawdown kill minus 0.5. IC scaling true 60.015. Spread scaling true. 40, 0.6. Okay, so this is the optimized model. So now let's run this. And I'm going to go to the bathroom really quick. I'll be right back. Sharp is not very high. Very long drawdown duration. Yeah. So at early times, there's a good mix of things scaling it down. Then at later times, it seems to be mostly the volatility scaler. Okay, let's try optimizing again. Except I'm going to change some things. So, number of positions it can suggest from 2 to 40. Rebalance days could be 1 to 5. Holding period could be 1 to 10. HRP look back could be 30 to 150. Buffer multiplier 1 to 3. Smooth predictions is either true or false. So let me think. What if I just take... No, that stuff I could leave on. Dollar neutral, beta neutral. Target volatility is equal to 1. Volatility look back is equal to, I don't know, 100 days. Max volatility leverage should be 1. Drawdown scaling. We want to turn this off, but how? So drawdown warning threshold -1. Drawdown kill threshold -1. Drawdown penalty 100. One. Oh no, IC scaling I do want to use. So IC look back could be something from 10 to 120. IC threshold could be minus to plus 0.05. Okay, so now I want to see, can I get, if I do just information coefficient scaling, shoot, did I exit out of that? I did. If I use just information coefficient and spread scaling, how can I do? Best trial 1.32. So it's already pretty high. If I just had spread and information coefficient scaling, that would be a lot better. .53. So what are the parameters it's finding? Autocorrelation of cross-sectional ranks. Healthy alpha models produce predictions where today's top decile is correlated with yesterday's top decile. .63, so it's still not very good. But maybe it just gets high if you can add volatility in there. Okay. Here's that performance of the last one. So I guess it's optimized for 2016 through 19, and it does well. Yeah. No bad drawdowns in that region. $1.9, that's not bad. Okay, 4 longs, 4 shorts. 9-day holding period. 4-day rebalance. This is weird. HRP look back 90. Smooth predictions true. Buffer multiplier 2.8. Sizing method beta neutral. Alright, so all the volatility stuff's off. Drawdown warning threshold is off. IC scaling true. IC look back 70. IC threshold 0.005. And that's it, huh? Spread scaling false. Well, that looks pretty bad. So let's try optimizing instead from 2016 through the middle of 2021. Okay, so that's it for now. I got to get to work. Thanks for watching. I'm going to keep working on this every day. I'm going to do another stream later tonight, so be sure to subscribe if you're interested. Have a good rest of your day. Adios.